Ladies and gentlemen, welcome back again. This is your brother Jamal bringing you another episode. I haven't recorded a video in about a few months. I'm sorry about that, guys. I took a break from YouTube and now I'm back with another episode. All right, a lot of you guys have been requesting videos from me. Here I am with another video again. By the way, today's video is going to be about market structure 101. It's going to be very basic, but very important, and I'll tell you why I'm making these videos. I've realized, including myself, when you start trading the market at the beginning, you start making money right away. But the more you learn about the markets, the more you lose. More doesn't make things better. Sometimes less is better in life. All right, this is why the doctors and the people that are most educated tend to overcomplicate everything, because in school they learn to perfect things. Perfection is what they learn, overanalyzing. Okay, so overanalyzing is paralyzing yourself. The more you know, the less you execute sometimes. That's why you see all those people who are very educated, they don't become very successful. They usually tend to work traditional jobs, 9 to 5, and make basic salary. And sometimes you see someone who never went to college, never graduated from university, but they become very successful in life and they figure things out very fast because they don't overanalyze things. Knowing the basic of the markets sometimes will help you. So if you don't know the basics, you're not going to be able to comprehend the bigger picture, okay? So let's get to this video here, all right? So basically the markets create 3 different scenarios. 70% of the time markets range, and then 30% of the time markets trend either up or down. All right, so there are 3 scenarios. The first one is market can be trending upward, and this is what we call an uptrend market. When the market is creating higher highs, a high that's higher than the previous highs, the market is going up. We call this uptrend, or in a different term we call this a bullish market. There's another scenario about the markets, and this one is what we call the sideways markets. The sideways is basically when the market, everything's balanced. The buyers and sellers are trading on equilibrium levels. Basically, they're trading on a balance level where the buys and the sells tend to be equal. Okay, this is when the market is ranging and not making any highs that's higher than the previous highs or any low that's lower than the previous lows. This is what we call a sideways market. And this is where the players or the traders accumulate their order, okay? Or fulfill the orders. The third scenario is when the price is creating a downtrend market. This is when the market is creating a low that's lower than the previous lows. We call this a downtrend market. And in other term, we call this a bearish market, okay? So, an example, first I'm going to show you guys as an illustration, and then we're going to go ahead and present it on the chart. If you're brand new to the channel, by the way, please go ahead and subscribe. Make sure you like this video, and don't be greedy. Just like I'm sharing with you, sharing this video with you, go ahead and share this video with your friends that are learning how to day trade. All right. First, we have, like I said, the uptrend. So this is how it's going to look like, okay? This is when the market is creating higher highs, higher lows. And by the way, guys, this is very basic and this is very important, all right? Knowing the basics will help you understand the bigger picture. If you don't know the basics, you don't know the advanced. Market structure is very important, so pay attention, all right? So, like I said, here we have low, we have a high, we have higher low, we have a high that's basically higher than the previous highs, as you can see, okay? All right, and now we have another higher low, okay? This is a little bit higher than the previous low, so we call this higher low, and now we have another higher highs, we have another higher lows, and we have a higher high. All right. Technically, what it means is this is the low, high, higher low, higher high, higher low, higher high, higher low, higher high. Each time the market creates a high that is higher than the previous highs, we call this a higher high. Like you can see the highs are getting higher, becoming higher. Market price is creating even higher. And the lows are higher than the previous lows. Okay? Markets continue going up like that, you see? All right, this is what we call an uptrend market or an uptrend market structure. The picture here, when you look at this, this is what we call a structure. Just like when you're building a building, you have to have the structure of the building, right? You have to put the bricks on top of each other, and that's how you build a nice, beautiful building. So just like that, we call this structure. So like you're building a building. When you look at this, this is a structure, all right, going up. All right, so each high breaks the previous highs, all right? Whenever the market breaks the previous highs, we call this a break of a structure, okay? Because the structure here was broken and the market created a new highs, all right? Each time the market does this, we see a break of structure. Here again, we have another break of structure. And here again, we have another break of structure. Each time price creates a new highs is basically breaking the previous structure, all right? So this is an uptrend market. All right, now we have something called a sideways market. Okay, 70% of the time, markets tend to range or go sideways, all right? And this is very important. Sideways markets are very important, okay? Markets tend to create a support and resistance. So when you look here, everything is equal. And when you look here, all the highs are equal, all right? So here we see the highs are not higher than the previous highs, and the lows are not lower than the previous lows, okay? And this is when the traders, the institutions, companies, governments, banks, this is when they accumulate their orders, okay? As you can see, the buyers and the sellers are both trading an equilibrium price action. They're both buying and selling a fair price action. This is what we call a fair price exchange. You can see everything is equal. Buyers are buying from here, exiting up here. Sellers are entering the market, exiting right here. Buyers are entering the market again, exiting right there. We call this line support, and we call this line above this resistance. So what is support is basically supporting the market from going down and breaking below the line. So basically the market is holding around this area. So this is what we call a support area. All right. And resistance is this line here. This line here is called resistance. What it does is basically preventing the markets from breaking above this line, and price is basically resisting from going up because traders are all trading on an equal, balanced exchange. All right. Everything is equal. Let's say if you're trading pound USD, they're basically trading on an equilibrium range, all right? And this is when the traders accumulate their orders. So the banks, because they have a lot of money, they tend to accumulate their orders when the market is ranging. When you ever see a ranging market, that means there's something cooking, all right? That's why a lot of people don't find out about a stock that goes up until it goes up. They don't see the company when things are down. But the moment the market goes up, that's when they realize, and that's when they start investing. But the big players, they invest and they trade and fill their positions when the market is doing this type of behavior. All right, that's why 70% of the time market tends to range or go sideways. The third scenario, my friends, is when price is creating a lower highs, lower lows. This is what we call a bearish or a downtrend price action. Here we can see we have a high, created lower lows, lower highs. Why do they call this lower highs? Because it's lower than the previous highs. Lower lows. Why do they call this lower low? Because it's lower than the previous low. And then another lower high, lower than the previous highs. Lower low, lower than the previous lows. Lower highs, lower than the previous low. And then lower lows. So here, anytime price breaks the previous market structure or the previous low, we call this again a break of structure, because the structure was broken. Price created a lower low, indicating a downtrend, and then now price pulled back, creating a low high, and then another impulsive to the downside, lower lows. And each time price breaks a structure, we call it BOS, or break of structure. You can see it here, another break of a structure, very beautiful. All right. So this is what we call a downtrend market structure, because you can see the market is basically going down. All right. So this is the three scenarios of what the market does. All right. Three scenarios: uptrend, sideways, and downtrend, which is a bearish market. Okay. So now let's look at the real chart and try to identify an uptrend and a downtrend market. All right. For example, let's look at the current price action over here. We can look at anywhere. It doesn't really matter. Okay. Here, if you see, the market created low, high, high, low, high, 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 low, high, high. What do we call this? This is what we call an uptrend price move. This is what we call an uptrend or a bullish market. And the reason why is because each time price is basically creating a low, high, higher, low, higher, high, higher, low, higher, high. As you can see, the highs are becoming higher and the lows are becoming even higher. So we call this higher lows, and then we call this higher highs. Okay, now each time the price breaks structure, we call this a break of a structure. You can see the structure is broken, price pulls back to rest, and then went up again. Again, we have here another break of a structure. So low, high, high, higher, low, high, 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 low, high, high. Before the break of a structure, you have to mark your lowest point. And this is what we call a higher low. We can see that this is our lowest point. This is our lowest point, and this is our lowest point. High, low, high, 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 low, high, 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 low, higher, high. Okay, now this is our last higher low. Before price started trending to the downside. And this is what we call a change of character. A change of character means basically the price action changed its character. It went from going up to going down. Okay? It went from going up to going down. So here we can see price created a change of character. Now we have a high. We have a lower low. But this is our lowest point after the break of exchange of this character. And then we have a higher high. Lower highs. Now we have a lower lows, lower highs, lower lows, lower highs, and then lower lows. All right. So price basically continues doing this all along. And then after that, we have what we call a sideways market. This is what we call a sideways market. This is why I tell you guys, sideways market is one of the best, because as an investor, you have to be able to identify when the big positions are placed. Whenever you see market creating a high, equals to low, and then a high, low, high, low, and then break of structure. This is what happens before we see a move to the upside or to the downside. All right. This is what we see before we see a move to the upside or to the downside. So price creating highs, lower lows, lower highs, lower lows, lower highs, lower lows. After that, what happened? Here we ended up getting a change of character, because this is the last lower high, created the lower low, breaking this structure over here. So now here we go ahead and mark our change of character. Once we get this change of character, now we have a high. Okay, we have a high. Price came back, tested an area of demand zone. We're going to talk about this one another day. And then price created a low, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, and then higher highs. Okay, what happened here again is we have another change of character. All right. So as you can see, price is always creating higher highs, higher lows. Change of character, price came back, took out all this area, and then reversed to the upside again, creating another higher high. Okay, so now it becomes our last high low, create a higher high. Now we have another change of character here. But this is the last high low, created higher highs before the break of this structure here. All right. So now we have another change of character to the downside. Boom, go ahead, market. Price now creating. Now you're looking for a seller's sell position, because we have now highs. And then now we have a lower lows, lower highs, and lower lows. Again, we get a change of character. This information might seem very simple, but to be honest with you, it's kind of a little bit complicated for a lot of people. Okay, but the more you practice on the chart, the better you learn. Again, price created a sideways market, as you can see. Price created a sideways market. Anytime before price creates an upside, a move, or a downside move, it creates a sideways market. Because why? The big banks, they have to accumulate their orders before they create a move to the upside or to the downside. All right. So here we have a low, higher high, higher low, and this is the last higher highs, and this higher lows, higher highs, higher lows. Always try to go deep into the pullback, or the deepest point here. We call this higher lows, because the lows are becoming higher than the previous lows, higher lows, and the highs are becoming higher than the previous highs. So this is what we call higher lows and then higher highs. And again, we have another higher high, higher low, and then higher high. And by the way, this is the current price action. Okay, so if you do this again, we have another change of character. Price continues this type of behavior. Okay, uptrend, sideways, and downtrend, bullish, ranging, and bearish. This is what we call a market structure. It's a structure. It's like a building. Either it's going up or down. All right. When the either it's going up or down, that's the easiest scenario basically. So now we have a high, and now we have a low. We have a lower highs, lower lows, lower highs, lower lows, lower highs, and lower lows. All right. You can see price basically tends to respect these patterns. High, lows, low lows, low highs, low lows, low highs, and then lower lows. Each time, this is what we call a downtrend market structure. So in this type of market, you'll be looking for a down movement. You can see sold, people are selling, sold, 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 and then will be maybe another selling again, okay, until we get a change of character, price creating an upside move, and then a pullback, and then it continues to the upside. Until we have that type of behavior, we're going to be going to the lower time frame and looking for a sell position. So this is the basic of market structure, guys. Remember, uptrend, sideways, or downtrend price action. I'm going to make another video pretty soon. Make sure you like this video. If you're brand new to the channel, please go ahead and subscribe. Make sure you like and share this video. If you want to learn the smart way, the best way to trade as a smart money trader, you can find my complete smart money trading ebook down in the description. Bestseller on Gumroad. So go ahead, and take advantage of that opportunity. Very cheap. Again, your brother Jamal. Good to see you all. I love you guys. Until next time, peace.